Hello everyone. Today we are going to talk about 5 common mistakes that a new investor do. Number 1 is lack of planning. Do not invest before creating a plan. Planning is the key to achieve your goals and knowing that what you can actually achieve. New investors are often guessing and blindly invest in stocks and appear to be performing well. Elements to consider are income and expenses, existing investments, risk tolerance, time horizon. The downside of not having a proper plan is that you don't have an end goal, and as a result, your investment model can be highly volatile. This, in turn, can make you a reckless investor, leading to a big losses if you are not careful. And second big mistake is avoid emotional investments. Emotions can be the number one ROI killer. Investors should not let fear or greed rule their decisions. Instead, they should focus on the bigger picture. Too often, when we see a successful company we've invested in, it's easy to fall in love with it and forgot that we have bought these stocks as an investment. Always remember that you bought these stocks to make money. This is clearly not the best way to invest or trade in stocks, as the companies you know or love are not always the ideal investment options according to your risk profiles. If any of the fundamentals that led you to buy from the company change, consider selling that stock. And the third biggest mistake is don't try to time the market. The falling knife has no handle. It makes no sense to name the ups and downs of the market. Trying to track the market also kills profits. It is extremely difficult to successfully plan a market. Even institutional investors often fail. You read the story of a successful stock investor like Warren Buffett and Google his portfolio, search results show his portfolio. You decide to buy that stocks or mutual funds or whatever that are mentioned in his portfolio. Because if he invested in them and made a name for himself in the stock market, you will think, what is wrong with imitating correctly? This is wrong. For example, this is one of the most common investment mistakes that private investors do. To avoid research and homework to find the best solution for themselves, they try to copy the portfolio of a successful investor and invest in the same companies. This approach is flawed for the following reasons. You don't know the entry point. Every time you invest in a business, it is important to know how much you should be investing in. When a stock is listed in a portfolio, you may not know when it was bought or what price it was bought on, and it might make sense for you to buy it at that particular time, or it might not. For example, the person whose wallet you are trying to copy may have bought the share when it was 20 and now it is 100. But when you buy it on 100 and the price goes down around 90, you will be in loss. You don't know at how much price he has bought. Needless to say, it is very important to know the correct price to enter, the level of risk you need to accept, and the correct time to exit. Mismatch in investor profiles and goals. Your risk profiles and goals do not have to match the well-known investor you are trying to copy. He may have more funds and a higher risk profile, which means he can afford more risk and may have invested in certain stocks. If you secure his investment, you will end up in the soup. He may have invested in risky stocks because he can afford them financially. If you copy his strategy, you will lose money and the determination to invest in the future. The entire portfolio cannot be public. Another reason is that a person's entire portfolio is never published. When a large investor invests in a company, retail investors do not know anything about until they have earned more than 1% of the company's share. When a person's participation in a company exceeds 1%, this must be made public. Thus, there is a huge possibility that there are several stocks in their portfolio that you may never know about, and that you will have an incomplete portfolio based on incomplete information. The information is publicly available. Finally, If you are looking online for a portfolio of a famous stock market investor, this information will certainly become publicly available to other retail investors as well. Most probably, this has already led to a rise of price of the shares. Needless to say, you are not doing anything else that would save you money, so you wouldn't benefit from such a long-term strategy. And the fourth mistake is diversify your portfolio. Everyone knows that you should not put all your eggs in one basket. Investment diversification formalizes this popular wisdom to create the only free lunch in finance. In other words, due to lack of correlation, the investor can reduce the portfolio risk without reducing the overall return. Diversification is important as it helps to find a balance between risky assets and more stable options. Thus, your capital cannot withstand the possibility of total destruction. Investing in just one asset class like stocks or commodities increases your risk significantly. And even if you are a risk sensitive investor, it is not advisable to put all your money in one basket. While professional investors can generate excess returns over benchmarks by investing in multiple concentrated positions, ordinary investors should not try to do this. It makes more sense to stick to the principle of diversification. The fifth and last mistake is take someone else's advice. Most often, we turn to our friends and friendly people for advice on important life issues, and finances are no different. However, when it comes to investing in stocks, relying on the advice of friends and just buying the stocks they have bought will not do good for you. It doesn't work because your risk profile and financial goal may be different from the other person, and it may not work for you. Do absorb the all information, but do your due diligence in the company and convince yourself completely. It is only when you feel that goals are aligned with the goals of the business that you need to go ahead and invest. There are so-called investment experts everywhere. Many experts are actually promoters. They are paid for the endorsement or have already invested in it. But this does not mean that their advice is wrong. They just do not think about your interest. As an investor, you should be careful not only with your investment choices, but also with your sources of financial advice. Do not trust anyone's analysis and investments or choices. Don't even mind. Always do your own research and make your plan yourself. This will help you in a long run. Thank you very much.